The market is falling. The market is falling. The market is falling. So you should probably sell every single stock you own and get out while you can, right? That is absolutely wrong. So I'm going to walk you through 3 steps that you should take when the stock market crashes. And depending on your age, depending on your status, depending on how much you have saved up, you're going to respond completely differently. But the first step above all else is you do not sell. I can't state that enough. Warren Buffett has a famous quote that says you're supposed to be fearful when others are greedy, and you're supposed to be greedy when others are fearful. Well, right now, at the time of this video, April 4th, 2025, most of the people in the United States are fearful when it comes to the stock market. Why is that? Well, we've been, hit with the news that Trump is going to raise tariffs across the other parts of the world. And that is something that is unsettling to a lot of people and a lot of businesses who will probably have to raise their prices. Because of that, the stock market took a huge hit, the crypto market took a huge hit, and seemingly overnight, now everything that used to be valued up here is really, really low compared to where it was 2 weeks ago or 2 months ago. So first, I want you to look at the previous crashes, and we're not even going to go all the way back to the Great Depression. We're not even going to go to the dot-com bubble that burst and all of the people that had their money invested in all these dot-com companies lost a ton of money. We can go back to 2008. We can go back to the housing crisis and how much the stock market fell in a matter of days. We can go back to 2020, and if you think about the COVID scare and the fact that the stock market fell 26% in 4 days during COVID, all of those people who sold their positions in those moments lost all that money and never got the opportunity to gain it back. Whereas the people that held on, that fought their emotions, they actually ended up way more wealthy over time. If you look at what the stock market did in the 4 years to 5 years after COVID hit. And that's why when you're in these moments, you have to have the mental fortitude to just hold strong, close things out, and let the market fall and pick back up without you closing out of your positions within your portfolios. The first step is don't sell. And some of the ways that you can actually guard your mind around not selling your stocks is have a number in mind of shares that you want to get to, either within individual companies, or if you're like me and you invest primarily in ETFs or index funds, how many shares of that ETF do you want? What does that look like over time? Once you get grounded in a certain target, then you're way less likely to want to sell off just because you see the market drop, right? So first step is to have a specific target of shares that you want to attain, and that will keep you focused and keep you from, fire selling things just because the fear has taken over. The other thing that you could do is look at history. Like I kind of mentioned before with, the depression and with the 2008 crisis and with the COVID crisis and all of these moments, look at what historically people did that would now be considered a mistake and don't do it. Back then, if you had talked to someone who sold their position, right at the heart of the COVID pandemic, you may think, all right, that was a smart move. You didn't want to keep losing money. But gains and losses aren't real until you sell. So if you keep that in mind, then you know that in this moment, and if it gets any worse over the next few weeks or months or even years, you know that over time the stock market is rigged to go up. Look at the last 100 years, and even though you see small dips in between some of those growth periods, over time that trajectory is going straight up and to the right. And that will continue to happen because so many millionaires and billionaires have so much of their money invested in the stock market that they cannot afford to lose it. And because the whales and the big money is headed in a certain direction, Anybody who attaches themselves and their finances to this vehicle will also flow in that direction. The next thing that can keep you grounded is having a specific investing time horizon. I think this is probably one of the most important things any of you can do when you buy a stock or when you buy a group of stocks as an ETF or an index fund. You have to understand that anything can happen in 3 months. Anything can happen in a year. You can lose 50% of your money by investing in great companies. But what will almost certainly happen is if you keep your money invested for 5 years, and if you keep your money invested for 10 years, there is such a low probability that you'll lose money investing in quality companies or quality groups of companies over a 5 to 10 year span, and history backs that up. So if you have the time horizon that's long enough, then you will be able to capitalize on all of the gains that you will get after a market dip. And the next thing outside of not selling that I want you to focus on is buying more. So this is probably completely counterintuitive to the way a lot of people think. When the market's at all-time highs, the fear of missing out, which we call FOMO, starts to really kick in. And now you just want to buy because you see prices going up. And in fact, that's the absolute worst time to buy. I've made this mistake so many times. You see Bitcoin raising through the roof. You see Ethereum going crazy. You see Nvidia going crazy. And you want to capitalize on this growth that you're seeing because you don't want to miss out on all these gains that other people are getting or displaying online and on social media and all these other places. But what you should really do is you should really, again, going back to the Warren Buffett quote, be very fearful in those moments. And you should say, hey, if we're at a 52-week high, or if we're at an all-time record high for, this cryptocurrency that I strongly believe in, then now is not the time to invest. The time to invest is when you wait, and wait, and then you see this dip or you see some adverse news that's on a global scale and you see prices drop, but not because the company is performing poorly, and not even because leadership did something wrong, but just because there's so much fear across the world or across your country that now prices are being pushed down, and you know that that quality company is going to continue to be here in 5 to 10 years, more than likely. So that is a great time to actually buy more shares. Also, if you think about why you should buy in this moment, part of the reason why is because that should be part of your strategy. So you've also got the strategy that says, I'm going to dollar cost average, and every single month, I'm going to buy on a certain schedule. If you set that up properly, then whether the market is at all time highs or dips to all time lows, you're still buying. You're still accumulating shares or accumulating crypto in a time where it's good and when it's bad. And what that does is that lowers your average cost per share so that in that 5 year, 10 year, 15 year, 20 year span, when you do want to sell some of those shares to invest in something else that's bigger and better, now you've got so much more upside because you were buying in these moments when the prices were compressed and when the market was depressed. So don't sell, step one, buy more, step two, and then step three. Step three is don't look. And I can't stress enough how important step three is, because when you think about investing, when you think about saving, when you think about paying off debt, the number one thing that keeps you from reaching any of those goals or any of those targets is your emotional state and the actions you take around the way you feel. So you don't want to look at your portfolio once you purchase shares on a down market, when you know that the news is bad and you know that when you log into that account, all you're going to see is red. There's going to be blood in the streets and you're going to be sad. Like, for lack of a better term, you're going to be sad. And if you're a newer investor, you might be scared as well. So you want to have your strategy in place. You want to buy the dip if you can afford to, if you have excess funds. You want to actually continue to dollar cost average so that you can build that portfolio up. And then you want to activate your strategy and not look at your stocks. My recommendation would be until at least a month has passed or until the news at a macro level is starting to get better. You'll see these things on news channels. You'll see people talking on social media. You'll see conversations happen around you at work where people will talk about how bad it is, how difficult the market is, how bad the economy is. And then when you see that rhetoric start to change, when you see people start to talk about how much they're gaining and how much the market is up, and when you start to hear news articles about the Dow reaching all-time highs and the S&P 500 breaking barriers, and those are the types of signs that you want to wait for if your mental state can't handle seeing all of those paper losses. Then you want to wait until you start to hear news that's swinging in the right direction, and then you can just have a funny story or a good story to tell that says, oh man, I remember when my portfolio dropped from here to there, but now thankfully it's doubled, or thankfully it's even higher than it was when I first started investing. So we've all been there. I've been there. I've sold at the absolute wrong time. I've bought at the absolute wrong time. I'm trying to save you from that experience. So by all means, please do not sell when the market is at an all-time low. Do not stop buying stocks, index funds, ETFs because the market is at a low. Because actually, that's when you get the best deals. You can be like a kid in a candy store shopping for deals. And do not look constantly at your portfolio because that'll make you depressed. And we don't want that. So, how do you go about getting comfortable when these markets are down? Well, part of it is lifestyle design. If you set up your lifestyle on the front end where you've done the things such as paying off high interest debt, having a security fund of just pure cash sitting in a high yield savings account, and coming up with your strategy for how much you're going to buy, when you're going to buy, and what cadence you're going to use, then you don't have to worry about all of the volatility of the market and all these things that are fluctuating. So think like a seasoned investor. Buy when the market is low, hold or sell when the market is high, have your debts covered, have side money sitting waiting for these opportunities. And last but not least, educate yourself and learn. Go to Yahoo Finance, go to some other sources, read up on these stocks, learn about this process, and be ready. And if you don't have the funds during this market crash, then use this as an opportunity to understand what these cycles look like so that by the time that the next crash comes along, you are ready, prepared, and you can just be chomping at the bit to get stuff on sale. So please, 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 if you find value in these videos and the things that I'm speaking to you about, then like, subscribe, share this video with someone who might need it. And by the way, this channel is designed to help you get the job you want, advance in the career you have, invest and save your money wisely so you never need a job in the first place. Thank you so much. I appreciate it.